it looks like the market price is at this point some sort of balance sheet impairment. If you look at sort of the additional tier one instruments, some of the contingent convertible notes and the write-down notes, they have seen a heavy, steep losses over the past few days. And I think that's an indication that it's really a Credit Suisse issue at this point, and that it could be that a balance sheet impairment is coming and that the market prices for some dilution for existing shareholders.
Invested in it.
Can I ask you then what we're seeing out there in terms of this risk on rally when it materialises? It feels like it's somewhat violent to the upside still, but we've had pockets of that before in this type of volatility in 2022, where effectively some market participants are very aggressive getting back off the sidelines because they've been so short. What do you make of the green that is just spilling onto the boards in the past week or so?
Well, I think it's a reflection of how far market prices have come. And at this point, I think valuations truly discount some of the risks we have been discussing for this year. And at this point, I think risk for equity prices have become much more symmetric. And I think that's what we see, especially this week with the sharp rebound earlier in the week. And even today, see some positive price action. I think that's just a reflection of a lot of those risks which have been moving prices down so far this year have become much more symmetric, and there is actually room for those negative dynamics actually to change over the coming months and quarters.
Yeah, Mathias, I hear you about symmetry, and that's where I'm concerned. Well, I don't understand what the valuations are telling me and our viewers at the moment. For instance, one of your charts shows the S&P 500 at around about 15 times forward. Now, compared with the last 5 to 7 years, that looks fairly good value. But compared to 20-year chart, it's nothing particularly fantastic as well. So, A, what do you think the PE is telling us? And B, is that the right measure that our viewers should be using? Is there another measure that is actually a better barometer?
Well, the US is probably the market, or say the US large cap market, the S&P 500, which is really driven by those very large companies, is probably the market which is at average. I agree, it's an average valuation, but I think that's where a fair market price is at this point, because we're not on the brink of a complete economic collapse. Risk premia are rather contained. So the repricing we've seen this year is entirely interest rate driven. So the market had to adjust to a higher interest rate environment. And I think as such, yeah, the market has become more attractive. Is it a steal from here? No, I don't think so, but it needn't be, right? Is PE the right metric? Well, there's always a chance that your denominator, that is the earnings, is sort of exposed to volatility. And I think that's also the case here. But what you can do is just simply think of what you expect for the next 5 years for earnings to be a sort of normalized trajectory. And I think if you use those normalized earnings, I think still we have an average valuation picture in the US for the large cap side. If you move into the smaller cap area, I think it looks more attractive. In Europe, we're clearly trading at fairly steep discounts, I think.